Welcome back, ladies and gentlemen. Okay, so today we got a ton to cover. So welcome to the Home Invest Show number 1. I'm Nate Armstrong, your host. Hey, so the mortgage rates, they're going out of control right now. Will they crash the market? That's what we're going to uncover today. I'm going to tell you some of the data on showings. What's happening right now across the market on showings? Are people getting more showings or are the showings falling off? I'm going to talk to you about mortgage application data. I'm going to go into some of the historical data of what's happened the last time that the Feds raised interest rates 2% in a short window of time. I'm going to be going through all of that and more. So buckle up. Let's go ahead and jump into this. I want to know from you. You can use the comment section. You can type down in the comments, will this interest rate hike, the hikes that we're seeing in this really short window of time, will this crash or slow down the market? What do you think? Will these interest rate spikes like this, is it going to crash or slow down the market? Let me know what you think. You know, there's a lot of theories, a lot of speculation on this. I'm going to show you what's actually happening right now, real time. The truth will come out in the future, obviously. We're going to be able to see that, but I want to show you real time. I am in the game of real estate investing. I'm investing heavily myself. Like I'm very, very active. I've been doing this now for 15 plus years. And right now I'm running harder than I ever have before with some of the assets that we're going after. And there's reasons for it. I'm going to show you why. I'm going to show you how all the numbers play together, but I track this stuff nonstop. You could call me maybe a geek, a dork, whatever you want to say, but like I get into this. I jam on it. I love it. It's what I like talking to my clients about. So I'm going to share what I'm tracking right now. Okay, so first and foremost, let me pull up this good old article from Forbes magazine. Okay, Forbes magazine, they're talking in this article right here about the demand for second homes has dropped to the lowest level that we've seen in a couple of years. Now remember, during the pandemic, second homes, like vacation homes, they became a really, really big deal. We saw some rural areas see 35% appreciation. 35%. That's crazy. I mean, it's even crazy that the housing market has gone up as fast as it has in the last year or so. But to see this in some of the rural areas, 35%, like that hasn't happened in most places across the country. It hasn't happened sometimes it'll happen in like a specific city because of a specific thing, but across the whole country, it's normal. It's not normal. Okay. But now with these interest rate hikes, guess what's happening? The mortgage applications for second homes is plummeting like a rock sinking to the bottom of the ocean. That's number one, the mortgage applications. That's like people applying for financing to try to get one of these vacation houses. The second thing that's happening is that the actual sales are starting to drop now. There's not as many people looking for a second home right now or a vacation rental. So that is what it is, right? Now, does that mean that the sky's falling? Does that mean that everything's coming down? I'm going to let you be the judge of that. I want to know your opinions of that. Plus, when you comment below, it helps bless these social media platform algorithms and lets this data get out to more people. So I would appreciate as you write your comments, your questions and whatnot below. We read every single one of them and we love to hear from you. So comment below on that. Let me know what your thoughts are on it. Okay. The second thing that I want to flip over to is this. Okay. I want to actually look at a leading indicator. I really geek out on this stuff and it's a passion for me. I've been in the game of real estate investing now for 15 plus years. I love it. When I jump on the phone with our clients, if you and I ever jump on the phone, like I jam about this stuff because I love it. It's just part of my DNA at this point. And so sorry if I get a little bit obsessed with some of these statistics, but I'm tracking this stuff really, really closely. What you're looking at on your screen right here, let me blow it up so it's bigger for you. What you're looking at your screen right here, this is a company called ShowingTime, okay? ShowingTime has been tracking house showings. So like what they do is they're the middleman. When a realtor lists a property for sale, they list it for sale, and then they're the middleman that like coordinates the showing. So like right now on one of my properties, I got a text message from a realtor who's not using ShowingTime. She literally texted me right here and she's saying, hey, can we do a showing tomorrow at 4:45 p.m.? She's not using ShowingTime. She's like doing it the old fashioned way because she physically wants to be at every showing. Most realtors nowadays don't do that. What they do instead is they contract ShowingTime or a company like them. ShowingTime is the biggest. And then ShowingTime does the back and forth. Hey, Mr. Seller, can you have somebody in the property to view the property tomorrow at 4:45 p.m.? Yeah, I can do that. Okay, good to go. And so that's what ShowingTime does. So ShowingTime has this beautiful data that gives leading indicators on what could happen. And so like if all of a sudden, you know, we're coasting along at a really high level of showings and it goes up and up every single week, every single month, that usually means there's more sales. When there's more people looking at properties, it naturally means more people are writing purchase agreements. When there's more purchase agreements, it naturally means that there's more sales. Well, what's happening right now? Okay, look at this graph. Okay, the dark blue line and this gray line, they're actually from 2020 and 2021. Okay, so we're going to kind of ignore those lines. We're going to look at it just because it could be relevant, but we're going to ignore them a little bit. And we're going to pay most attention to this orange line. Okay, this orange line, you can see here, since January, in the beginning of January, we saw a little bit of a pickup and then a little dip. And then what's been happening since January? We saw a pretty big dip. And then now what's happening right now? So you can see the reference point. They've got these up through basically the middle of April. So it's very, very timely. Like, it's not like some super old data. This is like just a few days old. And look what's happening with showings. We're dipping. We're dipping, ladies and gentlemen, right now in showings. So this is one of the best leading indicators that we can see on what sales will look like. Normally, spring market is a time when sellers list their properties, especially if we're talking like the northern half of the United States. The northern half of the United States, what happens during spring market is that everyone's been cooped up in their property. They've been cooped up way too long. Yeah, we'll just leave this up over here. They've been cooped up way too long during the cold months of winter. I remember as a child, I grew up in northern Minnesota, like, it was cold outside and people aren't moving. They don't want to pack up their house and move. So they don't want to list. They don't want to sell. And then additionally, like, you as a potential buyer, like, you don't want to buy in the middle of winter. You don't want to pack. So what happens is all this pent up demand gets pushed towards spring. And then as soon as the snow starts to melt, spring market is the time. So usually spring market, we see this lift, this surge, depending on the market we're talking about. But what's happening nationwide right now on average is the showings are dropping. The demand's dropping. That's not a good sign for the housing market. I'm not going to sit here and say it's doom and gloom. Not at all. Not at all, because I got some other data that I'm going to show you in a minute that actually, I'll just let you see it in a second. But it's not a good sign, okay? I'll tell you, like, even for me, this property that I showed you that the realtor is doing it the old-fashioned way, when I first listed a few weeks ago, that property had tons of showings, probably like 7 or 8 showings in a matter of 7 or 8 days. So like one a day. Tons, I guess, is a relative word, but it had a lot for a higher end property. And guess what? The last week, it's been crickets up until this one. So like, even me, I'm feeling it on my personal properties that I'm listing and stuff right now. So it's real. It's very, very real. So mortgage applications are down right now. Showings are down right now. Those are leading indicators going into the sales process. So what does that mean for housing sales? It probably could mean that we could see some softening. Okay. How much softening, I don't know. One of the gentlemen, he's a mentor of mine. He's bought over 3,000 apartment units in his life. We were having a little text conversation last night, and he really believes that, yes, some of the mortgage applications are going to slow and all this kind of stuff, and interest rates will continue to climb, but house prices aren't going backwards. That's his firm opinion. He's been in this game a long, long time. He doesn't think they're going backwards. He thinks that they're going to keep heading up north. And I want to look at that, okay? Because to me, it's really important. Like, I'm making big bets. I'm making good, safe bets. I shouldn't call it a bet, but I'm making good investments into solid real estate right now. And I kind of want to know. So I look at the history to try to predict the future. That's my best indicator. And I talk to smart people that have been in the game for a long time. And I'm looking at 2 things, okay? I'm going to first show you, this is called the CaseShiller Index. CaseShiller Index basically has been, they've been studying housing prices for nearly 100 years, nearly a century. And they've compiled the data and they put it all in a nice display format for us. And I just want you to look at this, okay? We saw a run up back in 2004, 2005, 2006, and then we had the crash. It's not like a stock market crash that's like overnight it just dips, but it's like a gradual settle down. Boom, boom, boom. That's typically what happens with real estate. And then we've had this big run up for a decade plus now. It's been running and running and running. And here we are today, okay? I want you to remember this because I'm going to flip over now to the 30-year fixed mortgage rate, the average 30-year fixed mortgage. What's happening with it? What does it look like? Well, here, okay? I want to get the time frame right, okay? Remember back in the 80s, I don't know what age you are or aren't. I won't make any guesses or anything like that, but I was a kid in the 80s. And my parents, the first few pieces of real estate they bought, actually, I know 2 of them for sure. They bought on something called a contract for deed, meaning they didn't go to a bank and take out a loan. They just went directly to the seller and said, hey, Mr. or Mrs. Seller, I'm going to make monthly payments to you and I'm going to pay you off to acquire your property. Once I finish paying you, then the property will be mine. And so they purchased properties like that. And I didn't know any different when I was a kid or anything like that, but that was like the thing because of these monster interest rates. Let me blow that up for you. Look at this. Okay. Monster interest rates, 16, 17, 18%. I even heard some people were taking out 20% plus interest rates during that era. Okay. That's not the point of this display. The point of this display comes down here. Let's look at history. Okay. History says back in 2005, right in this era, 2005 to 2007, 2008, history says, and I'm going to do the same thing over here so we can kind of do a side-by-side comparison to some degree. History says that when interest rates go up, look right here, okay? 2005, remember the housing market was getting hot. 2005, 2006, they raised interest rates and then the Fed backed off a little bit, just a little bit, not a ton. They went from 6.8% to 6.21%. And then they kept their foot on the gas. They got it up to like 6.69, you can see here. And then they had to let their foot off the gas. And the Fed will probably do that this time around. I don't know. They're being super aggressive right now, by the way. Like if you look at the rate hikes of then versus now, like right now, they got their foot on the gas. It's like, we are torching this thing. We're going to burn it down. That's what I kind of feel like. Whenever I look at this, I'm like, holy cow, Fed, are you kidding me? 2% in just a few short months. Like, wow, this is crazy. Okay. It didn't happen like that back in 2005. It was a little more subtle. Like, look at this. They were at the lowest was 5.41. Maybe you could argue and say it was 5.26. And then they gradually jumped it up to this 6.79. It was kind of the peak. So it was, but that's over like a 2-year window right there. You see that? That's what I'm talking about. Okay. But what happens? They raise the interest rate. So they hit the peak of interest rates on average for the 30-year fix. This is not including like subprime and all that kind of stuff, but the average peaked out at around June of 2007 at 6.69. So let's look at June 2007. June 2007. I got to go down here a little bit more. That's June 2006, June 2007, June 2007, right here, right here. Look at this now. The value started to come down. Okay. It wasn't right away. Let me flip back. It wasn't like the day they raised the interest rate, all of a sudden value started to come down. It's like a trickle effect 9 to 12 months later, depending. I know there's so many factors that go into housing. So like, don't get me wrong on this. I'm not trying to give you this is the exact date it's going to happen because it would be totally false. Okay. No one knows exactly what will happen. The government could step in. They could do some interventions. They could pull some more levers. Nobody knows. Okay. If anyone's telling you that they know precisely, please run for the hills because they don't. They just can't. There's too many levers that can be pulled in this whole thing. Okay. But what I want you to see here in this correlation is that even though interest rates went up, prices didn't come down right away. It took a little bit of time. It took nine or so months. In some zip codes, it could have even been longer. It wasn't like an immediate effect. Okay. So even though right now, and this is Nate theory, Nate speculation based on history, you can't take this as like your go-to plan. I'm not your financial advisor. I'm not your accountant. I'm not your CPA. None of those. Okay. But what I'm doing, the way I'm looking at this is I'm looking at this and I'm saying, okay, well, if the same that happened in the past happens here in the future, then what I'm going to count on is that these interest rates, if they hike high enough, it could probably cool off the housing market. It could even take it a little bit backwards. Okay. It could even take it a little bit backwards. And probably what had happened during the last time, I only know this because of true experience. I was buying a lot of what they called REO property, real estate owned foreclosures. What had happened last time is that some of the people that took out the loans that they never should have taken out, they ended up having to give those properties back to the bank. They couldn't afford the mortgage payments when interest rates were sky high and rents did not correlate. Rents didn't go up proportionally. Then all of a sudden they were going back to the bank saying, hey, bank, I can't afford this property. Here's the mortgage. Here's the deed. And they'd just walk away. And then consequently, it took the housing market down even further. It wasn't originally, I'm sure the Fed had good intentions. They raised the interest rates to cool things down, but eventually like those high rates caught up and they bit people and it sucked the whole housing market down. What will happen this time? what's going to happen? Okay. Well, on a bigger scale, I want you to pay attention quick to the 30-year fixed mortgage over time. Okay. We're looking at this basically since 1975, a good 30 plus year window on this. And look at this, 45 years. Look at this. Like, historically speaking, we actually are at a low interest rate right now. So when we're talking about like 5% rates, 6% rates, 4%, that's actually low compared to what historically we have seen. Okay, that plus some of the demand that's still out there, I think, this is again, Nate speculation, I think we got a little bit of running still to do. I don't know how long, and it could be different in your precise market. It could be different depending on so many factors, but I think there's still a little bit of running that can happen here. I just don't know how much more though. I don't know how much more. Okay, so what I'm doing right now is I'm betting on cash flow properties, not speculation properties. I know this. I had this really smart hedge fund manager come to me back in roughly 2009, right in this era, right here, right in this area. And he was doing some investments with somebody else in town. I lived in Minnesota at the time, and I got pulled in as a contractor for some regard, and then we ended up forming a relationship. I ended up meeting him at his hotel and kind of in his hotel lobby, by the way, like just catching up, trading business ideas on real estate investing and whatnot. But we ended up forming some sort of a friendship, and then a little while later, within a year or two, he ended up funding some of our properties, and then it kind of built from there. But what he was explaining to me during this whole time is that no one really knows exactly how things will play out. But when you've got opportunity that's in front of you, what you want to do is you want to play cash flow. Play cash flow. You can't speculate that we're at the top or that we're at the bottom because nobody really knows. Instead, what you do is you bet on consistent income coming in every single month. And if that income is combined with a 30-year fixed rate mortgage, one that's not going to vary, it's not going to go up and down, sideways and all that kind of stuff, then what can happen is you lock in at today's interest rates and today's rent rates, and let's just say you're making a little bit of cash flow. A little bit of cash flow is still good. It's positive income. It's bringing money to your pocket, plus you're paying down the debt every single month. And then what happens is that rents typically go up over time. And if you tuned into last week's show, you would see that what actually happened during the whole last recession, my personal rents went up. And they did a lot of historical data that I showed last week, rents went up. And so what he explained to me, this hedge fund manager, is that they were investing in cash flow, invest in cash flow. And so now me looking at the wisdom that I gained during the whole last crash that happened and looking forward at what's going on, I don't really care if the market goes up, left, right, down, sideways, up, upside down, around, back. I don't care. I really don't. I don't wish any doom and gloom on anyone. I don't want anyone to get hurt. But what I'm doing is I'm buying strategic cash flow properties. And then I bet what will happen over time, even if there's a blip or a slowdown or anything like that, I bet what will happen over time is that my rents will continue to go up. And then eventually my equity will go up as well. So that's the play that I'm making. You make whatever play is best for you and for your family. I'll tell you this, it does vary from person to person. I had a client that he's been in the game for a long time over in the stock market side. He came to me and said, "Hey, Nate, I got a few $100,000. What should I do?" And he was trying to do it through text message. And I'm like, dude, like, I don't know what you should do. And like, I would never want to speculate until we get on the phone and jam. And then eventually we got on the phone and we jammed and we mapped out a plan for him. But for you and for your family, you're going to do what's best. But if you want any guidance on this, if you want someone to give you another opinion, to show you the ropes on what we're doing on the cash flow side, to show you the actual investments that we're doing, and potentially if you're an accredited investor, you could even partner with us on some of them. If you're not accredited, that's okay. We've got other cash flow properties that kind of make sense to purchase as well. But if you're looking for someone to give you some oversight and some wisdom on it, then what I'd like you to do is type in the chat below 30-year fixed. 30-year fixed. Okay, 30-year fixed. If you just type 30, that's fine too, because I'm betting on fixed rate mortgages right now that create massive passive positive cash flow. That's the biggest thing that I can bet on. It's the biggest thing that I can encourage you to do. It's still really, really cheap money to get this. Look at this. From a historical standpoint, to get rates that are this low right now, if you can lock them in, historically speaking, these are some of the best rates we're still ever going to get. But bet on those. Don't bet on speculation. Don't bet on values going up and up and up forever, because they don't. They often don't. They do over time, but not in the short run for forever and ever and ever. So bet on getting a 30-year fixed mortgage on an asset that the rent has the potential to go up every single year. That's my advice to you, whether we do any business together or not. That's what I would tell you if you were my brother. Okay, speaking of my brother, they are here for holiday time, so I'm going to go and hang with the family. I hope you're doing well. I hope you got to have an awesome Resurrection Sunday, and I look forward to seeing you again next week. Okay, thanks. God bless. Bye-bye.